In the fast-paced world of Forex trading, understanding the strategies employed by major players is crucial for success. One such tactic is stop-loss hunting, a practice where institutional traders intentionally drive prices lower to trigger stop-loss orders placed by other traders. These stop-loss orders, designed to limit potential losses, become easy prey for these market movers. Stop-loss hunting is not for the faint of heart. It is a testament to the ruthlessness of the Forex market, where fortunes can be made and lost in the blink of an eye. Retail traders, often unaware of the forces at play, can find themselves caught in the undertow, their hard-earned capital vanishing in a matter of minutes. But what if you could turn the tables? What if you could anticipate these stop-loss hunts and use them to your advantage? This is the allure of mastering stop-loss hunting. The ability to not only protect yourself, but also to profit from the very strategies designed to exploit retail traders. This essay will delve into the depths of stop-loss hunting, revealing its secrets and empowering you with the knowledge to navigate this treacherous terrain. Institutional traders, armed with vast resources and market-moving capital, are the primary orchestrators of stop-loss hunts. Their motivation is simple: to generate liquidity and maximize their profits. By triggering a cascade of stop-loss orders, they create a pool of buy or sell orders that they can then exploit to enter or exit positions at favorable prices. Key levels in the market act as magnets for stop-loss orders. These include psychological levels like round numbers, previous support and resistance levels, and areas where technical indicators suggest a potential reversal. Institutional traders are acutely aware of these levels, and they will often use their firepower to push prices towards them, knowing that a wave of stop-loss orders awaits. Imagine a scenario where the EUR/USD is trading at 1.0950 and a major support level exists at 1.0900. Institutional traders, anticipating a large number of stop-loss orders placed just below this support, might aggressively sell the pair, driving the price down towards 1.0900. As the price breaches this level, a wave of stop-loss orders is triggered, further accelerating the downward momentum. The institutional traders, having created this liquidity, can then step in and buy the EUR/USD at a discount, profiting from the very traders they just stopped out. While it may seem like institutional traders hold all the cards, savvy retail traders can leverage their understanding of stop-loss hunting to turn the tables and profit from these maneuvers. The key lies in identifying potential stop-loss hunt zones and positioning yourself accordingly. One approach is to look for signs of a potential stop-loss hunt in areas where price action suggests a high probability of stop-loss orders being clustered. These signs might include a sharp, unexpected move towards a key level, a sudden increase in volume accompanying the price drop, or a cluster of long shadows on candlesticks indicating a rejection of lower prices. Once a potential stop-loss hunt zone is identified, traders can consider entering the market in the opposite direction of the anticipated stop-loss run. For example, if a stop-loss hunt is anticipated below a key support level, traders might consider placing buy orders just below that level, aiming to capitalize on the price rebound that often follows a stop-loss run. While profiting from stop-loss hunting can be lucrative, it is not without risks. The Forex market is inherently unpredictable, and even the most carefully crafted trading plan can go awry. Therefore, implementing robust risk management techniques is paramount. The first line of defense is to avoid placing your stop-loss orders at obvious levels. Instead, consider placing them a few pips above or below these levels, making it more difficult for institutional traders to pinpoint your stop-loss. Using a stop-limit order can add an extra layer of protection, ensuring that your order is only filled at a price you are comfortable with. Furthermore, it is crucial to manage your position size effectively. Never risk more than you can afford to lose on any single trade, no matter how confident you are in your analysis. Remember, the Forex market is a marathon, not a sprint, and preserving your capital is key to long-term success. By understanding the mechanics of stop-loss hunting, identifying potential stop-loss hunt zones, and implementing sound risk management techniques, retail traders can navigate this challenging aspect of the Forex market and potentially turn it into a source of profit.